Hi, it's Gina. We're talking about the difference between privately held and public companies. Those differences are pretty much outlined here. Private companies do not issue shares that are traded on the public market. The shares are held by only a few individuals, private individuals, and these companies are not subject to public scrutiny. Examples of these are like Cargill, which is a large food producer, Chick-fil-A, and Dell Computers. Public companies, on the other hand, issue shares that are traded on the open market. The shares are available to the public, which means to you and me. And these companies are subject to public scrutiny. The examples of these are Kraft, Yum Brands, and Apple, and here are the stock exchanges they're listed on and their ticker symbols. What is the government agency that oversees the stock markets? It's the SEC, the Securities and Exchange Commission, which was established at the peak of the Depression as an attempt to restore faith in the public stock market by investors, to designed to give investors confidence with transparent reporting and reliable information. And we find a lot of that information now on Edgar, which is the database site, searchable database for the SEC. And you can find these at these websites. Why is the work of this government agency important? Well, it establishes the rules and laws of basic information for reporting for investors. It ensures uniform reporting. It enforces violations of SEC rules compliance. And most importantly, it provides evidence of ethical, transparent, and corporate finance operations for public investors, which again could be you and me. Here's an example of the importance of this agency. So in response to the scandals of the 80s and 2000s, Enron, WorldCom, Countrywide Bank with its predatory lending, and then of course these happy Ponzi scheme dudes over here, the SEC established the Sarbanes-Oxley, or Congress established the Sarbanes-Oxley Act, which gave the SEC greater power in stricter oversight in corporate accounting and in greater power to enforce infractions. And then in 2010, they passed the Dodd-Frank Act, which was to protect against predatory lending. But here's a really interesting article by this guy, Ware, and he questions, can justice ever keep up with corporate sin? And he was writing about all the different airline and car companies that have been lying about their emissions and their guidance systems and things like that. So, can we ever keep up with corporate sin? Now, switching to our other topic, what is interest expense? That is the amount of interest payable on borrowings, and it is calculated periodically, so monthly, usually monthly, on the remaining principal balance. And what are loan costs? These are costs required to close a loan. For example, the taxes, which have to be paid up front, and the interest. Sometimes these are called points. You might have heard this called points if you're getting a mortgage. And these are costs that are payable over the term of the loan, so amortized over the loan. Why are decisions concerning how to obtain capital of importance? Because the long-term debt, as Baker et al. In chapter 22 notes, because long-term debt repayment obligations will have an impact on the cash flow of the company for the entire term of repayment, which can be years and years. So the factors to consider are before you consider taking out a loan or other types of financing, you've got to consider these things here. So the return on an investment, which is your net return divided by the cost of the investment, or the return on equity, which is another way of stating the return, divided by the fund balance or the owner's equity if it's a privately held company. The cost of that financing, so in other words, the interest rate of that loan, is it an expensive loan? Is the interest rate high? You have to consult your CFO on any tax implications associated with the financing that you're getting. And, most companies, including hospitals in our case, they have a formal approval process for financing, and that has to be adhered to. In another couple of references, I found some other considerations too, which is, you really need to understand the hospital's cash position and credit rating, because this is going to affect the kinds of financing that you can get. And some, this stuff here is talking about, traditional loans, but in addition to loans, there are bonds, there's off balance sheet transactions, there's leasing, there's selling off non-core assets to generate money and that sort of stuff. And then you may recall from the article that Dr. St. James sent us, mergers and acquisitions. Okay, so if you're a small hospital, maybe merging with other hospitals would be a financial benefit to you. If you're a large company or a large hospital chain, maybe you're going to acquire some smaller one and thereby gain their revenue as well. And so here are the references with these. These two references are very interesting for different kinds of financing, which I had no idea existed. And then here is that reference on corporate sin. So thanks very much.